Hey there, Ryan Walmsley, American Pacific Mortgage. Wanted to create this video to give you a forecast on what you can expect in the mortgage markets and the housing markets going into 2023. Now, we can't talk about 2023 without talking about 2022. And for housing and mortgage rates in particular, the story with 2022 was inflation. Inflation is a key driver in mortgage rates, and I'm going to dive deep into how inflation is going to influence the mortgage rates and the housing market moving forward. Now, for inflation, we measure that in a few ways. Inflation is measured with consumer price index or with personal consumption expenditure. The headline news that typically you see is CPI, and that's the measurement that we're going to use here, and that's this line in pink here, and the 30-year fixed mortgage is this other line here. I want to explain the relationship on how inflation is really what drives where mortgage rates go and not the federal funds rate, which is what you hear in the headline news when the Fed is making interest rate moves. They're not influencing mortgage rates directly. They're trying to combat inflation, and in turn that does influence mortgage rates, but specifically inflation is going to be the key driver. And as we see here over time, inflation and mortgage rates kind of move in step with each other. You see a increase here and then in inflation, and then an increase here in mortgage rates. Now, right here is the pandemic, the 2020 pandemic recession in this gray bar. And in March of 2022, the Fed stepped in and started purchasing mortgage-backed securities through quantitative easing, which is this period from here to here. And you can see that mortgage rates pretty much were following inflation until inflation started to peak. And this is the time period when we are hearing a lot about transitory inflation, and supply chains were the reason that inflation was picking up. But that wasn't the whole story. We know that there was part of inflation was coming from the supply chain issues, but also the food and energy crisis in Europe, and then also with backlashes from stimulus checks. And we knew at this point in time that inflation was starting to become a problem, but the Fed continued buying mortgage-backed securities until this period, after they realized that this dip, which they started to see, wasn't going to be sustained as it started coming towards the end of 2021. And at this point, they stopped purchasing mortgage-backed securities because it is inflationary. And then we started to see mortgage interest rates start to follow inflation as it normally would. So we started to see this peak up here, and then a leveling off, and then a leveling off in mortgage rates. And then as we're starting to see inflation roll over, we are starting to see mortgage rates come down. And this started in November of 2022. And that is, the components of this are interesting because we expect to have inflation continue to come down, and that's for a few reasons, and I'll show you right here. So when we're dealing with inflation, we're going to look at the core CPI, which excludes food and energy, which are the most volatile parts of inflation. And this chart here shows the month over month inflation numbers for core CPI. And when we're doing our comparisons and looking at year over year, we can start to see that the numbers are going to improve moving into 2023, as we can see here from October of 2021 versus October of 2022. This is where we started to see mortgage interest rates start to come down when the data was reported in November. So in November, they were reporting this October number, and we can see that there was a large increase here or a large improvement in inflation here between October of this year, or October of 2022 and October of 21. So mortgage interest rates followed suit as inflation started coming down. And we can see here that in November of 2022, inflation was still low. We haven't received the December numbers yet for 22, but we can expect that this trend continues lower here. And if that is the case, then we're going to see these year-over-year number comparisons get even better for inflation, meaning that we're going to see inflation start to come down. And simply because the comparisons are tougher doesn't mean prices are going to come down. It just means that inflation is starting to abate, and that's a positive thing, especially as we see looking forward into the future. The next 4 or 5 months, we have really good inflation numbers in comparison to where we are now. March might be a tough month for the markets because the comparisons aren't as pronounced, but then headed into late spring and into summer, we should see an acceleration and improvement in inflation. Now, a big part of this also of CPI is shelter. Now, shelter consists of rents and also owner equivalent rents. It makes up 39% of the core CPI. And this chart here is showing apartments rents. So this is our normal rents that we're seeing and how they spiked over this period here, but have come down significantly since the beginning of 2022. Now, looking at how CPI has changed over that same period, there's a lag here. And the reason why we're seeing this lag is simply because the data that gets reported into CPI is months old. So as we see an increase here in rents, we don't see the increase in rental inflation in the core CPI until much later on. Now, here's where we are currently. Rents are actually coming down, still going up at 4.6% year over year. So inflation on rents is decelerating, but it's not depreciating yet. But we're starting to see this rollover here in the CPI number, and at some point in the future we'll see it roll over, and we're going to see inflation improve even further as these comparisons get caught up to each other. And it's kind of like a roller coaster where you have the front line is coming down in inflation, coming down the slope, and then you have the actual shelter numbers in CPI still going up because of that lag effect. And we can see in the data that January of 2023 is really going to be that turning point for rents. So we should expect to see an acceleration in improvement in the core CPI because our real shelter costs are already coming down. The current data shows it, but the data that's used to calculate CPI is still lagging. So we do know that all other areas are already coming down as part of the CPI. Food, gas, clothing. These are big components as well. This is something that we are encouraged by, because if we're seeing these numbers coming down already on these consumables, then we're expecting to see an improvement when we see these shelter costs start to come down, simply because they're such a large part of the core CPI. And we're still in that lag period, but as the CPI reports come out in January, February, March, we're expecting to see a great improvement in inflation. And if we see that improvement in inflation, we'll expect to see that improvement in mortgage rates as well. Now, it's important to talk about the 30-year fixed mortgage rate versus the 10-year Treasury spread, because historically there's been a pretty consistent spread between those two asset classes, and it's normally between 175 basis points and 200 basis points, or 2 percentage points. So traditionally, we've seen this over 35 years that they kind of move in lockstep with each other until we get to the end of 2022, where we see the spread increase to 300 basis points or 3 percentage points. So why is that? Basically, the reason that we're seeing mortgage rates be higher than what they normally would be is because the expectation of refinances in the future by mortgage servicers. If a mortgage servicer expects to have to refinance interest rates that are in the high sixes, mid sevens, and they're going to see that in the next 12 months or so, 18 months, there's going to be less value to those mortgages that they service. So in turn, to make it worth it for them to purchase those in the first place, they're charging more upfront for those mortgages. So you may have seen higher rates and also higher costs to get those rates in the form of points. So what we can expect as interest rates start coming down, there's going to be less likelihood that those mortgages are going to be refinanced quickly in the future, making the servicing of those mortgages more valuable, and then bringing this spread back down to a more normal range that we're used to seeing. And in fact, it's already starting to narrow. We're starting to see the rollover as we've seen inflation peak and mortgage rates peak. So good news moving forward. Now, the next thing that we need to consider moving forward into 2023 is that a recession is coming. It's almost certain. Either we're already in a recession or it's right around the corner, but it's coming. And part of the reason why we can expect that is credit card and other revolving debt spending and also personal savings rates. So we are seeing, this is prior to the pandemic, credit cards, revolving debt rates, spending rates were going up, and then we hit the pandemic and we saw a huge drop off because people couldn't go anywhere or do anything. So there was a huge drop off in that. But come the middle of 2021, we started to see an increase back, and now we're well above where those spending rates were prior to the COVID pandemic. And if we look at personal savings rates at the same time, we can see here, this is the recession, the COVID recession here. Here's the first stimulus deposit, second and third, and then we've seen this steady decline in personal savings rates after that moving forward. So at some point, people are going to hit a wall on the balances that they have available with their credit cards and other revolving debt like home equity lines of credit, and at the same time they don't have as much savings to tap into as they once had even prior to the COVID pandemic. So what else can we expect with recession, and how can we predict that it's coming? Well, the yield curve inversion that we're experiencing right now is a almost perfect predictor of a recession. It precedes nearly every recession in the past, and we are well inverted at this moment in time. So basically what's happening is that 10-year treasuries are paying less in interest than 3-month US treasuries are paying, which is kind of a backwards thought on how it's supposed to work when you're lending money to the government. And that is in turn a predictor that there's problems in the economy. We can see here with each one of these gray bars here, which are recessions, that they were all preceded by an inverted yield curve. Here's an inversion and then recession, inversion, and then recession, inversion, recession, inversion, recession, and here we're well inverted, and we can expect to have a recession in the near future. So what is that going to do for housing? Basically, during a recession, we can expect mortgage interest rates to come down, but that's only part of the story. The other part is going to be demand for housing. And essentially, we can predict housing demand by household formations. And traditionally speaking, household formations are around 1.75 million per year. This chart doesn't go back very far, but it does show different moments in time where interest rates started to peak, and then we started to see improvements in interest rates, and then interest rates dropped off again. And here's where we're standing right now at household formations around 1.3 million. And basically, what a household formation is that when you have a child or a grown child living with their parents, they're wanting to get married, have kids on their own, and purchase a home, they break off and form their own household. But if they're unable to afford their own home because interest rates are high, we're going to see a drop off in household formations like we have. And the other piece of the puzzle is new housing supply. So new housing supply comes from home builders, and they're currently building about 1.5 million homes per year, and that is not necessarily enough to keep up with the demand. Or we are keeping up, but once interest rates start to go down, we're going to start seeing a reversal in that. Because right now we have 1.5 million homes being built, but we also have to replace 100,000 homes each year. So the total actual new supply comes to 1.4 million. With household formations at 1.3 million, we have supply currently outpacing demand. But as soon as we see those interest rates start to go down, the demand is going to spur again, and we're going to start to see more household formations. And really, builders could be building a lot more homes, but they're very cautious. They learned their lesson in 2006 to 2009, where half of builders went bankrupt and never came back. So we're in a situation where it could appear that there's a housing crash or prices are going to come down, but that's hardly the case at this moment in time. And as we can see, for price moderations, we're not seeing a crash. What we're seeing is a correction with prices only being down about 2.5%, even in the face of incredibly high interest rates in a very short amount of time. Over the last 10 years, prices are up 115%, and in the last 2 years, they're up 39%. So we're hardly seeing a crash at this juncture. But interest rates do influence how much people pay for a home, and let's talk about what affordability can look like in 2023. So if we're doing the math here and we're looking at 2021, assuming that the person or buyer needed a $400,000 mortgage, the rate at the time would have been, let's say, 3.5%, giving them a monthly payment of $1,796. From 2021 to 2022, housing prices did appreciate 10%. So if they were to purchase in 2022, they could expect to pay 10% more for a mortgage, but interest rates were considerably higher. Let's call it 6.25%, bringing the monthly payment, just principal and interest, to $2,709. That's an incredible increase of $913 per month. Now, at the same time, we have to look at household income to determine affordability. So the average household income for 2021 was about $9,000 per month. And these sources come from ADP. And these are people who stayed at their job in 2021. 7.6% people stayed. And there was, with ADP, they reported that an increase in their income for people that stayed at their jobs in 21 was 7.6%, and people who switch jobs, their incomes increased by 15.1%, giving us an average of about 9%. So when we increase that household income by 9%, it brings our new income to $9,810 per month. But we do know that in 2022, because of inflation, people were paying more for gasoline, food, and other services. So let's say that we're actually looking at an increase of $1,154. So that is kind of tough to, even assuming that in 2022 there was a 5% increase in their income, we're still having a tough time bridging that gap between these higher prices and affordability. However, looking forward to 2023, we expect interest rates to come down, which is going to bring down monthly principal and interest payments, and prices are going to moderate on gasoline, food, and other services as well. We're going to see that increase in household income, which actually brings affordability in 2023 to be better than what it was in 2022. So for our housing forecast, what can we expect? Well, we can expect lower inflation on goods and services, as well as rents and owner equivalent rents. We're likely to see recession-like slowdowns. We're going to see income increasing to help affordability, and we're still going to be in a very tight inventory environment, and rents still are going to be expensive and will continue to rise moving forward. So what does that mean to housing? We're likely to see low single-digit appreciation, and this is across the U.S. As a whole, and we're expected to see housing activity pick up as well. Now, what about mortgage rates? So we have some headwinds. We do know that there's global quantitative tightening happening right now. Central banks are no longer stimulating the economy, so that's certainly going to slow us down. There's going to be lack of foreign central bank buying, and then there's going to be more debt to be financed by these central banks. But some tailwinds that we can expect is lower inflation, which is the arch enemy of mortgage rates, and as inflation lowers, we can expect mortgage rates to lower as well. We're likely to get seasonal retail inventory to increase, giving buyers more options to purchase, and sellers will be more likely to sell as interest rates come down as well. So we could see a balancing of the markets there. We're likely to see an increase in mortgaging service values because of interest rates coming down, which will help accelerate mortgage rates to improve. And then we're also likely to be in a recession or on the verge of a recession, and mortgage rates typically decline during recession periods. So what's our bold prediction for 2023? We're likely to see 30-year fixed mortgage rates get to about 5.75% towards the middle half of the year, and then towards the end of the year around 5%, and we can expect the U.S. Treasury to be around 3% or lower. Now, if you're interested in talking about specific scenarios, I'd be happy to help. You can call or text me on this number here. You can email me at my apmortgage.com account. You can apply online at mywayhomeloanaz.com, and you can follow me on Facebook. And if you want to just like and subscribe to me on YouTube, you can do that just by doing that at the end of this video. So with that being said, I wish you and your family a very happy and prosperous 2023, and look forward to talking to you soon. Take care.